Question 1. What is the primary difference between a fixed annuity and a variable annuity? A fixed annuity guarantees a fixed return, while a variable annuity allows the return to fluctuate based on the performance of underlying investments. B. A fixed annuity can only be purchased by individuals over the age of 50, whereas a variable annuity can be purchased by anyone. C. A fixed annuity allows for early withdrawals without penalty, while a variable annuity imposes a 10% penalty for early withdrawals. D. A fixed annuity allows for inflation adjustments, while a variable annuity does not. Answer A. Explanation. A fixed annuity provides a guaranteed return, meaning the annuitant receives fixed, predetermined payments over the annuity's term. These payments are typically unaffected by market conditions, making them a more stable investment. On the other hand, a variable annuity has returns that can fluctuate as they are linked to the performance of underlying investments such as stocks, bonds, or mutual funds. The payment amount is not guaranteed, and the annuitant bears the investment risk. Option B is incorrect, as age restrictions do not define the types of annuities. Option C is incorrect because both fixed and variable annuities impose penalties for early withdrawals, particularly within the surrender period. Option D is incorrect because inflation adjustments are more commonly associated with specific annuity riders or features, not the inherent nature of the annuity itself. Question 2. Which of the following is not an example of an annuity rider typically offered to enhance a contract? A. Guaranteed minimum withdrawal benefit. B. Guaranteed minimum income benefit (GMIB). C. Long-term care rider. D. Accelerated death benefit rider. Answer D. Explanation. A long-term care rider and both the guaranteed minimum withdrawal benefit and guaranteed minimum income benefit (GMIB) are common riders that enhance annuity contracts by providing additional benefits such as access to income during retirement, protection against market risk, or assistance with long-term care costs. The accelerated death benefit rider is not typically associated with annuities. Instead, it is more commonly found in life insurance policies. It allows a policyholder to access a portion of their death benefit while still alive in cases of terminal illness, which is not a feature offered by annuities. Option A is incorrect, as GMWB is a well-known rider that ensures the annuitant can withdraw a minimum percentage of their account balance even if the account balance is depleted by withdrawals. Option B is incorrect, as GMIB guarantees a minimum income regardless of market conditions, providing security to the annuitant. Option C is incorrect, as a long-term care rider provides coverage for long-term care expenses, a common feature in many annuity contracts. Question 3. Scenario-based. Mr. Thompson, a 65-year-old retiree, is considering purchasing an annuity with a guaranteed minimum income benefit (GMIB) rider. He has a moderate risk tolerance and is seeking a steady income stream for the rest of his life. However, he is concerned about inflation eroding his purchasing power over time. What should Mr. Thompson do in this situation? A. Purchase an annuity with a fixed payout, as it will guarantee the same payment amount over his lifetime. B. Purchase an annuity with a GMIB rider, but ensure it includes an inflation adjustment feature. C. Opt for a variable annuity, which will allow for potential growth to combat inflation. D. Choose a deferred annuity with no rider, as he can invest his money in stocks to keep up with inflation. Answer B. Explanation. In Mr. Thompson's situation, the main concern is combating inflation while ensuring a guaranteed income stream. The Guaranteed Minimum Income Benefit (GMIB) rider guarantees a minimum income even if the account value of the annuity declines due to market fluctuations. However, the income amount is fixed and inflation could erode purchasing power over time. Option B suggests purchasing an annuity with a GMIB rider that includes an inflation adjustment. This is the best option because the inflation adjustment ensures that the annuity payments will increase over time to help offset inflation. Option A is incorrect because a fixed payout does not account for inflation and the payments will remain the same over time, leading to a loss of purchasing power. Option C, while it may provide the potential for growth, comes with greater risk, which may not be suitable for a retiree with moderate risk tolerance. Option D is not ideal, as investing in stocks can be risky and the annuity's guaranteed income feature would be sacrificed in favor of potentially higher returns from equities, which is not guaranteed and might expose him to greater market volatility. Question 4. What is the main purpose of a 1035 exchange in relation to annuities? A. To allow the transfer of an annuity to a different insurance company without incurring tax penalties. B. To convert a fixed annuity into a variable annuity, avoiding capital gains tax. C. To increase the annuity's death benefit without incurring additional premiums. D. To reduce the surrender charges on an annuity contract by exchanging it for a new one. Answer A. Explanation. A 1035 exchange allows a policyholder to transfer an annuity contract to a different insurance company or switch to a different type of annuity without incurring any tax penalties. The primary purpose is to provide clients with more favorable terms, such as better interest rates or different investment options, while maintaining the tax-deferred status of the annuity. Option B is incorrect because a 1035 exchange does not avoid taxes on the conversion of a fixed annuity to a variable annuity. While the exchange may be tax-free, it does not address capital gains tax issues. Option C is incorrect because the 1035 exchange does not relate to enhancing death benefits without additional premiums. Option D is incorrect because surrender charges are not directly reduced through a 1035 exchange. It may not necessarily eliminate them either. Question 5. Which of the following best describes the accumulation period of an annuity? A. The period during which the annuity payments are made to the annuitant. B. The phase during which the value of the annuity grows due to premiums and interest credits. C. The time when the annuity's death benefit is activated for beneficiaries. D. The period during which the annuity can be surrendered without penalties. Answer B. Explanation. The accumulation period is the phase in an annuity contract during which the annuity's value grows due to premiums paid and interest, credits, or investment performance. This is the period before the annuitant begins to receive any periodic payments. The distribution period. The accumulation period can last for several years and can include both fixed and variable growth depending on the type of annuity. Option A is incorrect because it describes the distribution period, not the accumulation period. Option C is incorrect because the death benefit is typically a feature that applies during both the accumulation and distribution periods, depending on the terms of the annuity. Option D is incorrect because annuity surrender is a separate consideration. Penalties typically apply during both the accumulation and early distribution phases, depending on the contract terms. Question 6. Scenario-based MS. Carter, a 72-year-old retiree, is concerned about outliving her retirement savings. She has saved a significant sum and is considering purchasing an annuity with a lifetime income rider. She is also contemplating whether to select lump sum payments or periodic payments for the income. What should MS Carter consider when making this decision? MS Carter should select lump sum payments to ensure she can leave money to her heirs. MS Carter should select periodic payments, as this option will guarantee income for her lifetime, addressing her concern about outliving her savings. MS Carter should opt for lump sum payments, as they allow her to invest the money independently, potentially earning higher returns. MS Carter should choose periodic payments because they offer tax-free withdrawals from the annuity contract. Answer B. Explanation. In MS Carter's case, her primary concern is outliving her retirement savings. By selecting periodic payments with a lifetime income rider, she ensures a guaranteed income stream for her lifetime, regardless of how long she lives. This addresses the longevity risk that retirees often face. The lifetime income rider guarantees that she will continue to receive payments as long as she is alive, providing peace of mind and financial security in her later years. Option A is incorrect because a lump sum payment would not guarantee a lifelong income stream in MS Carter risks running out of money. Option C is incorrect because investing the lump sum independently introduces investment risk, and there is no guarantee that the money will last through her retirement. Option D is incorrect because periodic payments from an annuity are typically taxed as ordinary income, not tax-free. Question 7. What is the primary regulatory requirement for an insurance agent when recommending an annuity to a senior consumer? A. The agent must ensure the annuity provides the highest possible return for the senior consumer. B. The agent must assess whether the annuity is suitable based on the senior's financial needs and risk tolerance. C. The agent is required to inform the senior that they have the right to cancel the annuity contract at any time. D. The agent must ensure the annuity includes a long-term care rider to address future healthcare needs. Answer B. Explanation. The primary regulatory requirement for an insurance agent, especially when dealing with senior consumers, is to assess the suitability of the annuity. This includes evaluating the senior's financial needs, risk tolerance, age, and investment experience to ensure that the recommended annuity product aligns with the consumer's circumstances. In New Hampshire, like many states, this requirement is designed to protect seniors from unsuitable sales practices. Option A is incorrect because agents are not required to maximize returns, but rather to recommend a product that meets the client's needs and situation. Option C is incorrect because while seniors have a right to cancel under the free look period, this is not the primary regulatory focus. The suitability standard is more critical. Option D is incorrect because while long-term care riders may be an option, they are not mandatory for all senior consumers, and annuities should be recommended based on individual needs rather than a one-size-fits-all approach. Question 8. Which of the following best describes the tax treatment of a non-qualified annuity? A. The entire amount of a non-qualified annuity is taxed when distributed as it is considered ordinary income. B. Only the interest or earnings portion of a non-qualified annuity is taxed when distributed. C. A non-qualified annuity is tax-free when distributed, since it is purchased with after-tax dollars. D. Both principal and earnings are taxed at the time of distribution, with the principal taxed at a higher rate. Answer B. Explanation. For a non-qualified annuity, the principal, i.e., the amount that was paid into the annuity, is not taxed because it was purchased with after-tax dollars. However, the interest or earnings generated by the annuity are subject to taxation as ordinary income when distributions are taken. This tax treatment applies during the distribution period. Option A is incorrect because only the earnings are taxed, not the entire amount. Option C is incorrect because non-qualified annuities are not tax-free. Only the principal is tax-free, while the earnings are taxable. Option D is incorrect because the principal is not taxed at all and there is no distinction in tax rates between principal and earnings. Question 9. Which of the following is a characteristic of a variable annuity? A. The annuity's payout is guaranteed to remain the same throughout the annuitant's lifetime. B. The annuity's value fluctuates based on the performance of the underlying investments. C. The annuity offers tax-free distributions if purchased with after-tax dollars. D. The annuity guarantees a fixed interest rate for the duration of the contract. Answer B. Explanation. A variable annuity is an annuity where the value of the contract and the eventual payouts can fluctuate based on the performance of underlying investments such as mutual funds, stocks, or bonds. The return is not fixed and the annuitant bears the risk of market performance. The main appeal of a variable annuity is the potential for higher returns, but the risk of market loss is also present. Option A is incorrect because the payout from a variable annuity can change based on the performance of the investment options selected. Option C is incorrect because variable annuities do not offer tax-free distributions. They are subject to taxation on the earnings portion. Option D is incorrect because a fixed interest rate is a characteristic of a fixed annuity, not a variable annuity. Question 10. Which of the following is a key feature of a fixed annuity? A. The value of the annuity fluctuates based on market performance. B. The annuity offers a guaranteed minimum return regardless of market conditions. C. The annuity requires the annuitant to make frequent investment decisions. D. The annuity does not provide a death benefit to beneficiaries. Answer B. Explanation. A fixed annuity provides a guaranteed minimum return on the principal regardless of how the market performs. The annuity's value is typically based on a fixed interest rate, and the payments to the annuitant are predictable. The principal is protected and the annuity does not involve direct investment decisions by the annuitant. Option A is incorrect because it describes a variable annuity where the value fluctuates with market performance. Option C is incorrect because the annuitant does not need to make frequent investment decisions in a fixed annuity. Option D is incorrect because most annuities, including fixed annuities, provide a death benefit to beneficiaries. Question 11. What is the main advantage of purchasing a joint and survivor annuity? A. It guarantees the annuity payments will continue as long as one of the annuitants is alive. B. It provides a higher payout for the surviving annuitant after the death of the first annuitant. C. It allows the annuitants to access their principal balance at any time without penalty. D. It is a type of annuity that allows for the accumulation of earnings during the payout phase. Answer A. Explanation. A joint and survivor annuity is designed to provide guaranteed income for as long as one of the annuitants is alive. It typically continues making payments to the surviving spouse or partner after the first annuitant dies. This type of annuity is ideal for couples who want to ensure that their surviving spouse continues to receive income after their death. Option B is incorrect because while the surviving annuitant may receive payments, they are typically at a reduced rate compared to the original payout. Option C is incorrect because joint and survivor annuities do not allow for free access to principal during the payout phase. Option D is incorrect because joint and survivor annuities are focused on providing regular payments, not accumulating earnings during the payout phase. Question 12. Which of the following actions would trigger a surrender charge on an annuity? A. Taking a partial withdrawal of the annuity's principal after the surrender period. B. Making a full withdrawal or surrendering the annuity during the early years of the contract. C. Annuitizing the contract and beginning the payment phase. D. Converting a fixed annuity into a variable annuity within the first 30 days of purchase. Answer B. Explanation. A surrender charge is typically applied when the annuitant fully surrenders the annuity or takes a large partial withdrawal during the early years of the contract before the surrender period has expired. This charge is designed to discourage early withdrawals and cover the insurance company's administrative costs. Option A is incorrect because partial withdrawals are usually allowed, although they may incur a charge if taken during the surrender period. Option C is incorrect because annuitization generally does not trigger a surrender charge as the funds are being converted into a guaranteed income stream. Option D is incorrect because changing from a fixed annuity to a variable annuity may not trigger a surrender charge unless the policyholder withdraws funds during the early contract period. Question 13, scenario-based. Mr. Davis, 65, is looking to supplement his retirement income. He has enough savings to cover his living expenses, but he wants to make sure he has guaranteed monthly income for the rest of his life. He is considering purchasing a single premium immediate annuity. SPIA, what is a major consideration Mr. Davis should keep in mind before purchasing the SPIA? The SPIA will provide immediate income, but he will lose access to the principal. B. The SPIA provides a guaranteed return of principal if he dies within the first year. C. The SPIA allows him to withdraw additional funds at any time without penalties. D. The SPIA will automatically adjust for inflation to maintain his purchasing power. Answer A. Explanation. A single premium immediate annuity SPIA requires a lump sum payment in exchange for immediate monthly income. However, once the lump sum is paid, Mr. Davis loses access to the principal because the funds are used to provide guaranteed income for life. This is an important consideration for retirees who need consistent income but want to ensure they understand the loss of liquidity. Option B is incorrect because SPIs do not guarantee the return of principal. They provide income based on the amount invested. Option C is incorrect because the SPIA typically does not allow for withdrawals outside the scheduled payments. Option D is incorrect because SPIs do not adjust for inflation unless an inflation rider is added, which is not a default feature. Question 14. Which of the following statements is true regarding the free look period in an annuity contract? A. It allows the annuitant to change the contract's investment options after the contract is issued. B. It allows the annuitant to cancel the contract and receive a full refund of premiums paid within a specified time. C. It applies only to fixed annuities, not to variable annuities. D. It permits the annuitant to reduce the annuity's death benefit without penalty. Answer B. Explanation. The free look period is a feature that allows the annuitant to cancel the annuity contract within a specified time, usually 10 to 30 days, and receive a full refund of premiums paid. This period provides consumers with an opportunity to review the terms of the contract and cancel it without penalty if they are not satisfied with the product. Option A is incorrect because the free look period does not allow changes to the contract's investment options. Option C is incorrect because the free look period applies to both fixed and variable annuities. Option D is incorrect because the free look period does not involve any changes to the death benefit. It pertains only to cancellations and refunds. Question 15. What is the primary difference between a deferred annuity and an immediate annuity? A deferred annuity begins payments immediately after the initial premium is paid. B. A deferred annuity has a waiting period before payments begin, while an immediate annuity starts payments right away. C. A deferred annuity provides income for a fixed period, while an immediate annuity guarantees income for life. D. A deferred annuity offers a higher guaranteed return than an immediate annuity. Answer B. Explanation. The primary difference between a deferred annuity and an immediate annuity is that the deferred annuity has a waiting period before payments begin, allowing the annuity's value to grow. In contrast, an immediate annuity starts providing payments right away after the initial premium is paid. Option A is incorrect because it describes an immediate annuity, not a deferred annuity. Option C is incorrect because both types of annuities can be structured for lifetime payouts or for a fixed period depending on the contract. Option D is incorrect because there is no inherent difference in guaranteed returns between the two types of annuities. Question 16. Which of the following is typically a characteristic of a variable annuity? A. It guarantees a fixed interest rate for the life of the contract. B. It allows the annuitant to allocate premiums to various subaccounts such as stocks, bonds, and mutual funds. C. It provides fixed monthly payments for the duration of the annuity. D. It does not offer any death benefits to beneficiaries. Answer B. Explanation. A variable annuity allows the annuitant to allocate premiums to a variety of subaccounts that can include investments like stocks, bonds, and mutual funds. The performance of these investments determines the value of the annuity, and the payouts can fluctuate based on the market performance. Option A is incorrect because a variable annuity does not guarantee a fixed interest rate. Returns depend on the performance of the investments. Option C is incorrect because variable annuities do not provide fixed payments unless specifically structured as such, and the payout amount can vary. Option D is incorrect because most variable annuities offer death benefits to beneficiaries. Question 17. What is the key feature of an annuity with a living benefit rider? A. The rider guarantees that the annuitant will receive a minimum income regardless of market performance. B. The rider allows the annuitant to make unlimited withdrawals from the annuity without penalties. C. The rider offers a fixed rate of return for the duration of the contract. D. The rider provides a death benefit that increases over time. Answer A. Explanation. A living benefit rider typically provides a guaranteed minimum income to the annuitant regardless of market performance or how the investments in the annuity perform. This ensures that the annuitant receives a predictable income stream even if the account value decreases due to market conditions. Option B is incorrect because living benefit riders do not generally allow unlimited withdrawals. They may impose withdrawal limits or penalties. Option C is incorrect because living benefit riders do not provide a fixed rate of return, and the return depends on the investment choices within the annuity. Option D is incorrect because the living benefit rider focuses on income guarantees during the annuitant's lifetime, not on increasing the death benefit. Question 18. Which of the following is a disadvantage of a variable annuity? A. The annuity offers no investment options for the annuitant. B. The value of the annuity fluctuates with the performance of the selected investments. C. The annuity guarantees a fixed interest rate for life. D. The annuity has a shorter payout period than a fixed annuity. Answer B. Explanation. One of the main disadvantages of a variable annuity is that the value fluctuates based on the performance of the selected investments, such as stocks, bonds, or mutual funds. This means the annuitant could face higher risk and the value of their annuity may decrease, unlike fixed annuities, which provide more stable returns. Option A is incorrect because variable annuities offer multiple investment options, such as subaccounts in stocks, bonds, or mutual funds. Option C is incorrect because a fixed annuity guarantees a fixed interest rate, not a variable one. Option D is incorrect because the payout period for a variable annuity can be structured in many ways and is not inherently shorter than a fixed annuity. Question 19. Scenario-based. Mr. Lee is 55 years old and has a $200,000 lump sum he wants to invest in an annuity for his retirement. He is concerned about his income growing over time to keep pace with inflation. Which type of annuity would be most suitable for Mr. Lee? A. A fixed annuity with a cost of living adjustment, COLA rider. B. A variable annuity with an inflation protection rider. C. A single premium immediate annuity, SPIA. D. A fixed indexed annuity. Answer B. Explanation. A variable annuity with an inflation protection rider would be the most suitable option for Mr. Lee. This type of annuity allows for the potential of growth based on market performance, and the inflation protection rider ensures that the annuity payments increase over time to keep pace with inflation, providing Mr. Lee with a rising income stream. Option A is incorrect because while a fixed annuity with a COLA rider offers some inflation protection, it may not provide as much growth potential as a variable annuity. Option C is incorrect because a SPIA provides fixed monthly income immediately and does not offer growth or inflation protection. Option D is incorrect because fixed indexed annuities offer returns based on a stock market index, but they may not provide the level of growth or inflation protection that a variable annuity with an inflation rider does. Question 20. Which of the following statements about annuity surrender charges is correct? A. Surrender charges are applied only to withdrawals made after the annuitant turns 70. B. Surrender charges are typically higher in the first few years of the contract and decrease over time. C. Surrender charges apply only to the principal paid into the annuity, not to earnings. D. Surrender charges are waived if the annuitant passes away during the surrender period. Answer B. Explanation. Surrender charges are typically highest in the first few years of an annuity contract and gradually decrease over time, usually following a schedule outlined in the contract. These charges are imposed when the annuitant withdraws funds or surrenders the annuity during the early years of the contract. Option A is incorrect because surrender charges are not dependent on the annuitant's age but are based on the contract surrender schedule. Option C is incorrect because surrender charges generally apply to both principal and earnings if withdrawn early. Option D is incorrect because most annuities waive surrender charges upon the annuitant's death, not just during the surrender period. Question 21. What is a key feature of an income annuity? A. It provides income for a fixed period regardless of the annuitant's lifespan. B. It offers the potential for high returns based on stock market performance. C. It provides a steady stream of income for as long as the annuitant lives. D. It requires the annuitant to make monthly contributions until retirement. Answer C. Explanation. An income annuity provides a steady stream of income for as long as the annuitant lives, ensuring that they will not outlive their income. It is designed to offer lifetime income, making it ideal for retirees who want predictable, ongoing payments. Option A is incorrect because income annuities typically provide lifetime income, not for a fixed period. Option B is incorrect because income annuities are not typically tied to stock market performance. Option D is incorrect because income annuities do not require ongoing contributions once the contract is purchased. The annuitant makes a lump sum payment to receive income. Question 22. Which of the following best describes the accumulation period of an annuity? A. The period during which the annuitant receives payments from the annuity. B. The period during which the annuity grows based on the premiums paid in investment performance. C. The period during which the annuitant can make withdrawals without penalties. D. The period during which the annuity contract is in force, regardless of premium payments. Answer B. Explanation. The accumulation period refers to the time frame in which the annuity's value grows based on the premiums paid and the performance of the underlying investments during this time. The annuitant is accumulating the funds that will later be used for annuity payments. Option A is incorrect because payments are made during the distribution period, not the accumulation period. Option C is incorrect because withdrawals without penalties typically occur after the accumulation period and often after a certain age. Option D is incorrect because the annuity contract can be in force for many years, but the accumulation period specifically refers to the growth phase. Question 23. Which of the following statements is true about fixed annuities? A. Fixed annuities provide returns based on the performance of the stock market. B. The payout amount for fixed annuities can change based on inflation. C. Fixed annuities offer guaranteed rates of return. D. Fixed annuities typically come with a high-risk investment option. Answer C. Explanation. A fixed annuity offers a guaranteed rate of return, meaning the annuitant's principal is protected and they receive predictable, fixed payments for the duration of the contract or their lifetime. This makes fixed annuities a low-risk investment option. Option A is incorrect because fixed annuities do not depend on stock market performance. Option B is incorrect because the payout amount in a standard fixed annuity does not adjust for inflation unless an additional rider is added for that purpose. Option D is incorrect because fixed annuities are designed to be low risk with no investment options for high risk investments. Question 24. Which type of annuity is best suited for an individual looking for a guaranteed income for life but does not want to take on the investment risk of a variable annuity? A. Fixed annuity. B. Indexed annuity. C. Variable annuity. D. Immediate annuity. Answer A. Explanation. A fixed annuity is the best option for someone seeking guaranteed income for life without taking on investment risk. It provides stable, predictable payments based on a fixed interest rate, ensuring that the annuitant's income is secure regardless of market fluctuations. Option B is incorrect because indexed annuities offer returns linked to the performance of a market index but still carry some risk. Option C is incorrect because variable annuities involve market risk where the payments can fluctuate based on investment performance. Option D is incorrect because immediate annuities offer immediate payments but do not necessarily guarantee income for life without a fixed interest rate. Question 25. Scenario-based. Mr. Rodriguez is considering purchasing a fixed indexed annuity. He is concerned about the potential risks of market downturns but would like the opportunity for some growth based on market performance. Which feature of the annuity is most likely to address Mr. Rodriguez's concerns? A. The annuity provides returns based on a stock market index with a cap on the potential returns. B. The annuity guarantees a fixed rate of return for the entire contract period. C. The annuity includes a living benefit rider to guarantee income. D. The annuity offers a risk-free, non-market-based interest rate. Answer A. Explanation. A fixed indexed annuity offers returns based on the performance of a market index, such as the SP 500 with a cap on the potential returns. This allows for growth potential linked to market performance while still protecting against market downturns through a minimum guaranteed interest or floor. Option B is incorrect because fixed indexed annuities do not guarantee a fixed rate of return. Instead, they are linked to a market index with potential caps. Option C is incorrect because the living benefit rider relates to guaranteed income, not growth based on market performance. Option D is incorrect because the annuity is not risk-free. It still depends on the index, albeit with protections against loss. Question 26. What is the primary benefit of purchasing a deferred annuity? A. Immediate income payments. B. Tax-deferred growth of the principal. C. Guarantees income for a specific period. D. Protection against early withdrawal penalties. Answer B. Explanation. A deferred annuity allows for tax-deferred growth of the principal, meaning that the money invested in the annuity grows without being taxed until it is withdrawn. This can be an advantage for individuals looking to accumulate funds for retirement or other future financial needs. Option A is incorrect because deferred annuities do not provide immediate income. The income begins after the accumulation period ends. Option C is incorrect because a deferred annuity does not guarantee income for a specific period until the distribution period starts. Option D is incorrect because deferred annuities may still have penalties for early withdrawals during the accumulation phase. Question 27. Which of the following is true about the surrender of an annuity? A. Surrendering an annuity always results in no financial penalties. B. Surrender charges are the same throughout the entire life of the contract. C. Surrender charges generally decrease as the annuitant's age increases. D. Surrender charges are typically higher during the early years of the contract. Answer D. Explanation. Surrender charges are typically higher during the early years of the contract and decrease over time. This is designed to deter annuitants from withdrawing their funds too soon. The charges usually follow a schedule that decreases as the contract matures. Option A is incorrect because there are usually penalties for early withdrawal, especially during the first few years of the annuity. Option B is incorrect because surrender charges decrease over time, not remain constant. Option C is incorrect because surrender charges are not based on age but on the contract surrender schedule. Question 20. What does the free look period in an annuity contract provide to the annuitant? A. A set period to change the annuity's investment options without penalty. B. A period during which the annuitant can cancel the annuity contract without incurring a penalty. C. A time frame to transfer the annuity to another insurance company without taxes. D. A period in which the annuitant can change the payout options of the annuity. Answer B. Explanation. The free look period provides the annuitant with a specified period, usually 1030 days, during which they can cancel the annuity contract and receive a full refund of the premiums paid without incurring any penalties. This allows the annuitant to reconsider the decision after reviewing the terms of the annuity. Option A is incorrect because the free look period does not apply to changing investment options. Option C is incorrect because the free look period does not apply to transferring the annuity or any tax-related provisions. Option D is incorrect because the free look period does not apply to changing payout options, but to cancelling the contract altogether. Question 29. Which of the following best describes an annuity's death benefit? A. It provides a lump sum payment to the annuitant's beneficiaries if they die before the annuity's income payments begin. B. It guarantees that the annuitant's heirs will receive a percentage of the annuity's accumulated value at death. C. It allows the annuitant to pass on their annuity payments to their beneficiaries regardless of market performance. D. It provides a guaranteed stream of payments to beneficiaries for the duration of their lifetime. Correct answer A. Explanation. The death benefit of an annuity is typically a lump sum payment to the annuitant's beneficiaries if the annuitant dies before the income payments begin. The benefit can be the value of the annuity at death, ensuring that the beneficiaries receive some compensation for the investment. Option B is incorrect because not all annuities provide a percentage of the accumulated value. It is usually a lump sum or a set death benefit amount. Option C is incorrect because the death benefit does not necessarily guarantee payments regardless of market performance. D is incorrect because a death benefit typically provides a lump sum, not a guaranteed stream of payments for the beneficiary's lifetime. A guaranteed income stream would be a feature of a payout option or income rider, not a death benefit. Question 30. Which of the following best describes the exclusion ratio in an annuity? A. The percentage of the annuity's payments that are subject to taxes. B. The percentage of the annuity's payout that represents the return of principal. C. The portion of the annuity's income that is guaranteed to be paid to the annuitant. D. The amount of the annuity's payment that goes toward administrative costs. Answer B. Explanation. The exclusion ratio in an annuity refers to the portion of each annuity payment that is considered a return of principal which is not subject to taxation. The ratio determines the amount of the annuity payment that is taxable, the portion that exceeds the original investment. Option A is incorrect because the exclusion ratio is about the return of principal, not the taxable portion of the payment. Option C is incorrect because the exclusion ratio is not related to guaranteed income but rather to how much of each payment is considered the return of principal. Option D is incorrect because administrative costs are not related to the exclusion ratio, which focuses on the portion of the payment that is non-taxable.